G'day traders, I'm Greg McKenna. Welcome to Markets Morning. It's the 17th of December 2018. Almost there, almost time for a bit of a break, but not quite yet. We've got to get the Fed out of the way and we've got the Bank of England as well. But realistically, it's the Fed. There's a lot of pressure on the Fed to circuit break what's become a pretty aggressive market funk. Now, stock market funk, I should say. Now, US stocks on Friday night, the S&P closed just below 2,600, and that kind of suggests that it's going to fall towards sort of 2,500, 2,523. Now, the important thing about this in the context, there's a lot of hand-wringing, a lot of, the Fed's got to save us, all that kind of thing. When you have moves in markets, the garden variety retracement is your 38.2% retracement. That's about 2,500. So you can have a retracement to 2,500 and still go higher. And so that's kind of my base case. We're in a bit of a funk. Credit market's all a bit tight, all that kind of stuff. So it's the weekly today because it's Monday, so I'm going to walk through the weekly. But first of all, I want to say thanks. I want to say thanks to the subscribers who have joined me in this new journey of McKenna Macro. This will be a private video from now on, so only you will see it. I will send you a link and you will get access to it. I believe that's the way it's going to work. Hopefully today we'll sort it out. And so from there, then I hope obviously to grow this. But thanks for supporting me so I can support you. But thank you, thank you, thank you. I really do appreciate it. Anyway, what do we got? We've got a market on the cusp. We've got a market on the cusp that really needs Jerome Powell to backstop it. Now, US dollar bears really need Jerome Powell to backstop them as well because they don't want the dollar index to get up and through 97.70. They don't want the dollar against the euro to get down and through 112.65, heaven forbid 112, because that really starts to open up some bottom side for the euro. So it really is down to Powell. But what is he going to say? We've got wages growing at 3.1%. We had the Atlanta Fed on Friday night upgrade the estimate for Q4 GDP back to 3% because of personal consumption. Now, that's really important. We've got tight labour markets. And there was a survey I shared in the Markets Morning written piece last week that talked about the fact that they said that even though they're a bit concerned, they're going to spend more this Christmas. So that tells you something about the economy. Anyway, we can talk about these things as I go through. Lots of charts to talk about. The key takeaway from my scan over the weekend, when you look at the correlations, when you look at all the markets, is it's really down to the Fed. The correlations of Aussie yen, of gold, of bonds, they all suggest this is starting to become a real market funk. And in the written piece today, I have talked about credit. I've led off with credit. I shared a thing on credit this morning from the FT. It was about 4:30, 5 o'clock, something like that, just because I thought it was interesting. It has been reshared and reshared and reshared and commented and reshared. People are genuinely worried. And that narrative is important. Because as though you can find lots and lots of people who say the US economy is fine, and I'm one of them. I'm not by any stretch of the imagination worried about a recession anytime in the next sort of year or two. I think it would be a big policy misstep from the Fed. I guess I have the benefit of being an Australian who has lived in Australia and worked through tough times with the RBA and seen what they do. They move, they pause, they adjust, they evaluate, they adjust, they keep going that way. That's what the Fed's going to do. And so the Fed will, I believe, look at in 2019 lower growth, but I don't think it's going to be looking at a recession. Anyway, let's dive straight into the charts. I've got to turn this way because I've reordered the room. Anyway, so this is the S&P 500 weekly. What do you see here? Well, we closed at 2597 in CFD terms, but that's the bid. And this fractal here, which was support previously, is 2603. So we're only a few points below, 6 points or so. But when you have a look at that, you see that we are starting to break down. That is quite a catastrophic chase back for the bulls. If we think about it in the Bill Williams terms, top third means the bulls won, bottom third means the bears won. Over the course of last week, the bears won. Now, what's important about this? I'm a sell the rallies bent at the moment because Jimmy R, not only have we had a cross of Jimmy R, which is the 15 and the 30, but we've had a coincident cross of the 15, the 30, and the 50. Now, on many markets, over many time frames, over many years, that triple cross is a big, big warning. Go and have a look. I haven't actually back-tested it. It's just anecdotal. I was going through everything over the weekend going, oh, there's a triple cross. There's a triple cross. There's a triple cross. There's a triple cross. Both up and down. So that's the key here. We have had a triple cross. of the 1530. So Jimmy R plus the 50, whatever you want to call that. And so that for me means we are a sell on rally. So a Powell rally, a Fed rally would for me be a selling opportunity. Declaring a hand, I'm short. I got short. Remember last week I said I was short. I closed it out because I thought it could get to 77.83. It got there and then reversed. Well, on Friday, there was just you could just see in the price action things were getting funky. There's this whole kind of little thing happening in foreign exchange markets, in other markets, and I just looked at the S&P and thought, meh. So I got back in at the same level, 44. So what do I do now? Back into the lifestyle position of being short. I'll run it down into the sort of the 25, 20, 25, 30 region. It's only a very small position. That's why I call it a lifestyle position. But overall, this is a sell rallies market for me now. We will probably, at some point lower. We will equally, at some point, have a position squaring pre-FOMC move. So that's my time, Thursday morning at 6 o'clock. So there's a lot of hours of trade to go between then and now. Let me just fix this up so it fills the screen. In terms of the Dow Jones, the Dow Jones is the only major market that I follow that has not had a cross in the Jimmy R. It's looking that way though, isn't it? Similar kind of story. The Bears won that one. NASDAQ. Now I know more of you trade foreign exchange and trade stocks, but this is a cross-asset look at the world, right? And, you know, there's all these currency tourists and macro tourists out there right now who want to say, well, because the Fed's going to go dovish, that means the US dollar must fall. Guys and girls, there is more than one driver of a foreign exchange rate, of a currency rate. There are two sides. Euro, US dollar. Aussie, US dollar. Euro, yen. Sterling, yen. You know, euro, sterling. Dollar, lira. You know, dollar, yuan. All that kind of thing. There's two sides. So that means that at worst, there's at least two drivers, but there's also many, many more. So the Fed pausing is important, but in and of itself, it is not the only driver. So that's important. We'll come back to that though. For the NASDAQ, we had another weak one, but it hasn't made a fresh low in the way that the S&P has. 6449 has to hold, otherwise you get a big cascade low, at least to the February low, which is 6,000. So quite a few points there. You know me. You've watched these videos. You've put your faith in me by subscribing. I'm not prone to panic, but the market does look quite dangerous now. Caution is warranted. What have we got here? We've got the triple cross. Remember the triple cross I talked about? We had that back here for the Aussie market. The Aussie market is just clinging to lows. Last week's low, I think, was 55.20 in SPY terms. Yeah, 55.20. That's got to hold. Otherwise, we're talking about 5,200, 5,300, maybe even 49 something is the key thing. Now, it's going to get ugly for a sec here because I'm going to open. No, it opened up there. That's good. I want to show you a Russell chart from my weeklies that I did, the platinum stuff. And I'm not trying to sell you anything. I just wanted to show it to you if I can find it. Unless I've merged it into a document, which I have. No, there it is. There's Apple 22B, IWM. Here we go. This is a Russell ETF. Now, I know at least, it's very strange, it turned up over there. I know at least one of you trades this actively, but the reason I want to show you this is that what it shows is the broad nature of the US selling, and it has broken. So previous resistance and support is now broken. So that is quite a poor outlook for stocks. So our market too weighed down, underperformed US markets to the max. You know, should it really be this week? The Australian economy is slowing, so there's a fundamental headwind. The banks' demand for bank product is down, so there's a fundamental headwind there as well. So our market remains under pressure, and that fractal there, which is 5,000 to me, looks like might be the medium-term level that we start to think about and I start to talk about. The DAX in weekly terms, shoulder, head, shoulder, target 9,800. That remains in force for me. Medium-term Jimmy R downtrend is in place. In terms of currencies now, let's move forward. So the euro Friday was a bad day for global data. It really was. That Chinese retail sales weaker than expected. Chinese investment was slightly better than expected by 0.1. Industrial production worse than expected. You know, you put that together with the trade data, you put it together with the PPI and the CPI data, and you've got a real sense that China's slowing. And then we got PMIs out of Europe. You know, Mario Draghi tried to paint a happy face on it on Thursday night my time, and then Friday we got the preliminary, very preliminary at the 14th or something of the month, preliminary PMIs from market, and things have fallen out of bed. France has completely fallen out of bed, down in the 49s. Obviously the yellow vests don't help, but what have you got is you've really got that undermining of what Mario Draghi said. And as you know, if you've been watching me for a while and reading me for a while, I always talk about this China-Germany linkage, something that Flano, first showed me in graphical form back in 2010, 2011, 2009. I don't even remember, but we were at Newcastle Permanent. If China is under pressure, Germany's got it doubly because it comes under pressure itself from what it sells to China, but also because China will compete harder. So Europe is really under a bit of pressure at the moment. And what does that mean? That means the economic surprise indexes for Europe and China collapsed last week, both down 20 points. Europe is now negative 76. China is now negative 19.7 from a positive number the week before. The US, by contrast, is negative 7.3. And emerging markets, believe it or not, negative 1.5. Canada, strangely, is actually plus 20. But these are kind of against expectations, don't forget. So what does that do? Is if I go back to what I said about the euro, if the Fed pauses, US dollar has to fall. Yes, if you abstract everything else. But what you can't abstract is weak data in Europe. And that is what weighed on euro. Now, it did a good job, as you can see here. It's still stuck between the 15 and the 200 in terms of moving averages on a closed basis. So it hasn't broken down yet. And 112 is the key here. 112.65, then 112. Top side, 114.50 or something like that would be resistance. We'll delve in a little deeper as the week goes on. If you have a look at dollar yen, the key for dollar yen, I'll shrink this back down to the normal size. The key for dollar yen is 114.50 to 114.80. I've slightly increased it from 114.75 based on some of the work I did over the weekend. If you get up and through 114.80, then we are heading into the 118s would be my projection based on what looks possibly like a reverse head and shoulders. But abstracting that, just a pure Fibbo of this move, which had a nice consolidation, puts you up there. Now, naturally, if stocks are going to fall out of bed, pardon me, then dollar yen should have a handbrake on it. And then you might see a euro yen move, for example. So going forward into the Fed, there might be some good opportunities. And I'll talk about these tomorrow maybe, because I don't think much is going to happen tonight in foreign exchange land unless stocks go off. But, you know, euro yen, euro sterling, sterling yen opportunities may present themselves. And speaking of sterling, on a weekly basis, we've got to break down and through 126.60. Unless or until sterling can get back up above 126.60.90, then the medium-term downtrend, the Jimmy R, is still pointing lower. And on that basis, a move towards sort of 124.70.80 is the next target for me. And obviously, that chart would suggest that you could even get a run all the way back to the 15 EMA, which comes in, if I can pick that up, at 128.46 and still trade 120. It's becoming a digital option in many ways for Brexit. They're either going to rescind Article 50, have a new referendum and stay, or they're going to go out hard. I didn't think the British political class would let it get to this, which is one reason why you look at charts, because your historical self and your chart self, or your trading self, if I could put it that way, are different people. And that's an important part of how you manage yourself when you're managing trading, because the management of trades is as much the management of self as it is of trades. I remember when I was at State Super, you know, we'd trade 200 or 400, or one day I sold $1 billion, and you get used to that kind of thing. But what happens is, I remember I was then working on the desk at Westpac, and my old boss came in and asked for a price in 200 after the day guys had gone in the twilight zone before London came in and asked it of the night guy. And he was a bit freakish, and I offered to help him manage it because I was used to those size positions. Now, of course, I was the strategist. He told me to go and get stuff. That's fair enough. But management of your emotions and yourself, luckily, I knew that my boss would be selling somewhere else as well, so they cleared out the position pretty quickly. Anyway, that's important because you can get caught. Your rhetorical self can be completely wrong. What have we got? You'd have to say, we've had a really big, long down move in the Aussie. We've had this retracement. It didn't get to 74.40, which was the 38.2% of that move from 81 cents. It got to 73.93 or thereabouts. Then we had that big bearish engulfing week, and now we've had a follow-on with a down week and a break of that trend line with that bearish engulfing. 71.60 traded below that on Friday, which was the 3 or 4 weeks back, was the up move that we had an inside week of. So we need to close down and through on a day basis first, 71.60. Then we've got a real bearish engulfing. If we close down through 176.60, then we're looking at 70.20, that sort of stuff. But I'm looking in 69s then. We get below 71.60, I'll be looking in the 69s for the Aussie. That looks like it's a recommencement of the downtrend, and I'm a seller on rallies of that one now that the outlook's turned. Dollar CAD really, really close to a break. 133.85 is a level I've been talking about for a long time. As I said, that that CC score for Canada isn't too bad, all things considered, which is a bit of a handbrake on dollar CAD, but dollar CAD is starting to break higher. Its correlation with oil, the Canadian dollar, over a 95-day period is really quite strong. It starts to really weaken when you get to the 35, and when you get to the 20s, it's not really there. And that's one of the really interesting things about currency markets broadly at the moment. You look at them and you think, oh, it's all about the US dollar. It's not. Those correlations on a 20-day basis and a 30-day, 35-day basis are not as strong as you would think. So there's a lot of idiosyncrasy. So the other side, the euro side, the sterling side, the Aussie side, the Canadian dollar side, the kiwi side, they're all really important. But for the CAD, I'm encouraged, pardon me, by last week's 133.90 close. The uptrend is certainly there, and we'll have to wait and see because it does look, I think we can target 138 on that close. I'm just going to have to bite the bullet on that one. In terms of kiwi, looks like it's rolled. That fractal, it can't get back above that fractal. And for me, obviously the 30 is support now, and that comes in around 67.70, and then we've got support at 67.45. But for me, I'm targeting that candle there, which has got a low around 67 as my target for the outlook. Now, Jerome Powell and the Fed, I could be completely wrong, which is the problem with your rhetorical self. That I've expressed a view based on my read of the data and my read of them, but what I'm expressing to you here in these charts is my view of the charts, which doesn't necessarily always tie up. When your fundamental view and your technical view tie up, that's when profits are collected. And so on that basis, if my fundamental view ties up with a close above 97.70 in dollar index terms, or below 112.65 initially and 112 eventually for euro, then I would expect a powerful move. But we have to see that close to back up the rhetorical self first. What have we got here? We've got dollar yuan moving higher on the back of weak data. I personally think China's happy for the data to be seen to be as weak as it is, because it helps them with the Americans when it comes to discussions about the currency. Because there's a fundamental reason why the currency should be weak, Mr. Mnuchin, Mr. Ross, and Mr. Lighthizer. So I think that is part of the game. So expect the Chinese data to continue to look weak. Dollar Sing moved up. So we've still got this kind of rolling period, but that was a pretty strong week. I'm now expecting Dollar Sing to head back towards range highs. Now let's quickly do commodities. Gold on the 200-day moving average, 1255, 1256, came back. I said Friday I thought it would come back to 12.37 or thereabouts. It's done that. Where are we now? The correlation between Aussie yen and stocks and gold and bonds and Aussie yen and bonds and those kind of cross correlations tells me that this is a real market funky kind of period. If bonds rally, so keep your eye on bonds, 278 to 280 on the 10s. If they get down and through that, I would expect dollar yen to be lower and I would expect gold to be higher. For the moment, though, it does look like it needs to come back to test. It may even test, 12.27. And if that was to go, then maybe 12.08 or somewhere like that. That support there is 12.26. So that was the 12.27 region I had in mind. In terms of silver, still in the range. It's got to get up and through 14.90 to 15 to really get moving. And I've just lost my connection, which is no fun. But it shouldn't matter here because I've already got the charts there. So watch just a range there. In terms of copper, we've now got this wedge is still going forward and still building. We wait for a resolution. The fact that it didn't go down and through on that Chinese data the other day is important. It's an important signal because it means that there is a lot of expectation already built into the copper price. But for me, $2.67 to 64 needs to hold. If it was to break, then I'd be looking for $2.55. And if $2.86.5 to $2.87 breaks, well, then that can get you a run towards $2.93. And heaven forbid if we get above $2.93. The current backdrop doesn't seem conducive to that. Looking at Brent and WTI on a weekly basis, the key thing is we're back in the old range. That low needs to hold, otherwise we're heading to 45.45. I've just realised what the time is. I'll get my skates on. Similar story here. There's a $5 to $10 fall, pardon me, for both. If that's an inside week, so that doesn't tell you anything. That just suggests that you'd go with a break either side. But again, it's trying to hold above the previous range here for oil. Mexico's announced that it's increasing supply. It's clearly... The Iranians are clearly worried because they're now talking about how well OPEC works. Bitcoin, there is no bullish case for Bitcoin. I can see on a chart. You can make all the hodl reasons for buying Bitcoin you like. As an asset, it is looking increasingly weak. Anyway, that's it from me. New York Fed manufacturing tonight. NAHB business survey. That'll be closely watched. That could be a US dollar negative. We've got inflation data in Europe as well, but otherwise it's fairly quiet for the next 24 hours in that sense. Price action, and particularly price action in US stocks, is there going to be follow through? And also have a look at Markets Morning, the written piece. There's lots more in that. Have a great day. I'll be back tomorrow. Bye for now.